I'm at the Waldorf Astoria Hotel in New York City for REITWeek 2011, NAREIT's Investor Forum. Joining me is Steve Brown, Senior Portfolio Manager and Global Head of Real Estate for American Century Investments. Steve, thanks for joining us.
Thanks, Alan.
Now, I understand that you guys have started up a new global real estate fund. Can you tell us a little bit about it?
Sure. We launched a global real estate fund on May 1st, and it's an actively managed, diversified product. We're running it out of our New York office, and we also have offices in London and Hong Kong.
So it's a pretty global take there. Where do you find the interest is coming from among investors?
Well, we have a fairly large sales force at American Century, and we've had a lot of reverse inquiries from our pension fund and institutional clients for a global product. They've really accepted global real estate as part of their asset allocation or investment decisions, and we've had a lot of success with our global general equity products at American Century. So it was a natural rollout in terms of our global and non-U.S. products. Okay,
well then, give me the scoop. What's your take on what's going on globally with real estate? What markets are hot?
I think when we look at the global investment universe, and particularly real estate stocks, what we see is diversity and opportunity. There's a lot of different levels of economic activity globally. There's some regions of the world where we're seeing the countries hike or increase their interest rates to slow down the economic growth and to fight inflation, whereas other regions, such as the United States, we're nowhere near considering raising interest rates because of the modest current levels of economic growth. So we see a lot of diversity in terms of the economic regions we can invest in. Secondly, there's just enormous amounts of differences demographically. Some regions, such as Brazil or China, are experiencing a lot of consumer growth, consumer spending, consumer growth, much stronger, say, than Western Europe or the United States. So again, you can look at some types of real estate, such as retail, that are benefiting, even though it's an inflationary environment, they're just benefiting from a absolute growth of consumer spending because of the population demographics in some of those regions.
Let's bring it a little bit closer to home. U.S. REITs, we've seen a modest recovery so far this year. What's going on there?
Well, it's June 2011. And what we've seen recently is a little bit of a slowdown in some of the economic data coming out of the United States. Consumer spending has been modest, economic activity has been modest, and so is hiring. And what we see here is that we're basically coming to the end of the QE2 effects on the economy, and we could be in for a period of modest GDP growth in the U.S. of, say, 1% to 2% a quarter for the next couple of quarters. But we're also seeing interest rates continue to go down. The 10-year is around 3%. So I think that if we continue to have this modest and sort of slow economic recovery coupled with low interest rates, I think U.S. REITs could deliver outstanding results relative to the S&P 500 because, again, we're experiencing recovering fundamentals in commercial real estate. We expect 8 to 10% dividend growth from U.S. REITs this year. And if the 10-year stays at 3 or dips lower, then that'll just make REITs look that much more attractive relative to other investment ideas.
All right, well, Steve, thank you very much for your time.
Thanks, Alan.
For more information on this and other REIT news and analysis from REITweek 2011, check out REIT.com.